I now hand the conference over to Mr. Sameer Kothari, Managing Director, Hindustan Foods Limited. Thank you, and over to you, sir.
Thank you so much. Good afternoon and welcome everyone for our Q3FY21 earnings conference call. I am joined today by Ganesh Ardekar, who is the Executive Director on the board of Hindustan Foods, Mayank Sarlani, who is the Group CFO, Vicky Solanki, who is the Head of Corporate Communications, and Bankim Purohit, who is our Company Secretary. In addition to that, as usual, we are being mentored by SGA, our Investor Relations Advisors. I hope everyone has had a chance to go through our updated investor presentation, which has been uploaded on the exchange and also on our company website. Coming to the performance of this quarter, we've had a good quarter, and on the back of the continuing expansion and the ramping up of the new facilities, we've been able to post the highest turnover and the profitability numbers in the history of Hindustan Foods. While we did improve our operational performances, I think it is important to clarify that a certain part of our turnover was actually boosted due to reasons completely out of our control. A key raw material saw unrealistic increase in prices, and since our business model necessitates passing on the increase in the cost to our principals, this has resulted into a nice boost to our turnover as well. However, in addition to the increase in the turnover, this also led to some margin erosion. But as Mayank, our CFO, will explain in detail during his talk, this margin erosion is temporary in nature, and we hope to recover this in the coming quarters. I'm pleased to inform you that the company now has a gross block of nearly 350 crores and is planning to invest another 250 crores in the coming few months. I think the on-time and the within-budget execution of the projects which have resulted into this large gross block is a testament to the hard work which our team has put in. This team is headed by Ganesh, our Executive Director, Prasad, our Head of Projects, and the operations team at Hyderabad headed by Govind, and the one in Silvassa headed by Manish. I am really proud of the work that these guys have done in the last year or so. Coming to the immediate future, we are very excited about the upcoming projects in UP, which will see the company investing close to 125 crores in the new product category within food space. Though I am not at liberty to discuss what specifically product category we are going to start manufacturing in that location, I am personally very bullish about this category and believe that as contract manufacturers, we could see some great opportunities in this category in the future as well. In addition to this investment, we've also announced and started work in this quarter in the brownfield expansion in Hyderabad. And we've also announced a new smaller Capex investment in our associate company, Atc Beverages, in Mysore. I am confident that all of this put together with the current factories which are running should help us achieving our turnover of 2,000 crores by next year. Before I hand over the call to Mayank, who will take you through the financial numbers, I just want to say that we at HFL are very excited about the future and are chalking out our plans for the next financial year and beyond. While this is work in progress, I can just tell you that the plans are quite aggressive and the opportunities are unlimited. So we are very excited about the future. I will now hand over the call to Mayank, our Group CFO, who will take you through the financial numbers for the quarter and for the 9 months ended December 31st, 2020. Mayank?
Hi everybody, good afternoon everybody. This is Mayank here. I will go through the financial performance of the company for the quarter and the 9 months ending December 2020. So first, when we talk about the quarterly performance, we are very happy to share that the growth momentum in the business has sustained. Our total revenue for the quarter grew by 85% year-on-year basis to rupees 384 crores. Our strong year-on-year revenue growth has further reinforced our strategy for the decentralized manufacturing and proven the benefit of contract manufacturing. Our EBITDA for the quarter has seen a growth of 49% YOY, which stood to 22.4 crore as against 15.1 crore in Q3 FY20. EBITDA margins for the quarter were impacted basically due to, as Samir indicated, that the raw material prices have increased, but due to our business model, this increase would have been passed through. However, there is a time lag in that passing through. So as indicated that we will recover this erosion but in the quarters to come. There are some other factors which are affecting margins. Just like one of the reasons was the shoe business, which was affected due to the lockdown in Europe. And within the shoe business, what we have done, it is affected by the higher logistic cost, which is increased by 25 to 30% in the quarter. If I talk about the 9 monthly, our PAT has registered a growth of 97% year on year, which stood at 12.6 crores against 6.4 crores in Q3 FY20. PAT for the quarter includes benefit from the reversal of excess provision of tax for last year in the tune of 3.86 crores. The same has been adjusted in the quarter after filing IT returns. However, even without considering this adjustment, the company has achieved the highest PAT ever. If I talk about the 9 monthly performance, for our revenue has been registered a 73% year-on-year growth and stood at 904 crores as against 524 crores in 9 monthly FY20. Our EBITDA for 9 monthly FY21 has seen a growth of 52% YOY, which stood at 60 crores as against 39 crores in 9 monthly FY20. Our PBT has registered growth of 33% year on year, which stood at 33 crores. Our PAT has registered the growth of 62% YOY, which stood at 25.2 crores as against 15.6 crores in 9 months FY20, but this includes the one-time adjustment of reversal of tax. Our net worth for the 9 monthly FY21 stood at 213 crores. As Samir mentioned in his speech, we are constantly investing in Capex. Company has invested nearly 190 crores in around 200 crores in last two years. In addition, we are expecting to invest additional 250 crores in next 1 year for manufacturing of personal and home care products and food and beverage products. Despite consistently investing in our Capex, our debt to equity ratio stood at 0.91 times for 31 December 2020. Further, as a result of our prudent financial practices, India Ratings has recently upgraded our long-term credit rating to NA with a positive outlook. This upgradation will result in reduction of borrowing cost for the company in coming future. Nonetheless, the interest rate has already been reduced by approx 40 to 50 basis points based on our negotiation with the bank already. With this, I would like to open the floor for the questions. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anand Trivedi from Nifty Capital. Please go ahead.
Hello, can you hear me?
Yes, we can hear you, Anand.
Okay, congratulations on a great set of numbers. My first question was, you mentioned that the margins have come off partly because of the raw material prices going up, which you've passed on, but not entirely, and for the next couple of quarters that will be passed on. And then second comment which I heard was the logistics cost for the shoe business, if I heard that correctly. And I just want to get a little more granular on that. The margins on the gross profit have gone down from 12.5 to 9. So how much of this is a function of the raw material prices which will come back in the coming quarters? Is it 90% or it's 70% or what?
So Anand, we are unable to give you exact details on the cost of the raw materials which gets transferred because frankly, this is a specific raw material which has to do with a specific customer of ours. But if you're familiar with our business model, you can be rest assured that the entire cost of any increase in the raw materials gets passed on to our principals. If not in the same quarter, definitely within the next quarter.
Okay, so then going forward, would 12.5% gross profit margin would be a sustainable number?
Sorry, Anand, let me just address your other question. And I think that should give you some idea. So while in the dedicated manufacturing business, the raw material prices are passed on with a lag effect, but they are definitely passed on. In case of the shoe business, that's a permanent loss that we've faced in this quarter. However, the shoe business now accounts for a very small portion of the business. So from that perspective, I can just tell you that we are quite confident that more or less whatever margin erosion you see should get recovered within a small time lag.
Okay, great. The next question I have is that in terms of your Capex, you have close to 300 crores of Capex, which should be done in the coming year, correct? Over the next 12 months?
Yes, around 250 crores, Anand.
Okay, and so is that all completely funded, or you need to raise any money for that?
Mayank can answer that. We don't need to raise any funds, but Mayank can give some more details on that.
So Anand, we have already raised. We are fully funded based on where, as far as the equity concerned. We need to raise the debt, which we will do that in the coming future, and we are confident that internal accruals and the equity which we raised earlier we will be able to fund these projects coming on.
So how much of this 250 will be from equity?
The normal debt to equity ratio for our projects, we look at around 75-25. So if I have to give you a thumb rule, it will be around 25% of 250 with the equity.
Okay, and I'm assuming in all of this,
which will be completely from internal accruals. So we won't be raising any equity for this.
Okay, and I'm assuming the 18% ROE model remains for this Capex as well.
Yes, Anand, the ROE model remains. I don't want to get into the discussion about whether it's 18% or not, but yes, the model remains the same.
Okay, great. Thanks so much.
Thank you. We'll move on to the next question. That is on the line of Himanshu Nair from Yes Securities. Please go ahead.
Hi, good afternoon, Samir and team, and congratulations on a good performance. So, firstly, as you said that the opportunities in this business are endless, so just wanted to understand your thoughts on the client concentration bit. So, are we looking to get more and more business from our current top 1 or 2 clients, or are we looking to diversify our client base a little bit? And if you can share what would be our contribution to top line from the top 2 or 3 clients as well?
Hi, Himanshu. Thank you. So let me first address the macro question that the opportunities that we are seeing frankly across the customers, we are seeing it across product categories, and we are seeing it across geographies. As you are aware, Hindustan Foods has always tried to hedge its bets, diversify across product categories, geographies, as well as customers. So today, we manufacture in close to 11 locations across the country. We manufacture products from pesticides to baby food, and we work with practically all the FMCG companies in the country. So going as far as the client concentration bit is concerned, so client concentration for us is a moving target. What ends up happening is when a particular project or a particular couple of projects come online for one particular customer, obviously the concentration of that customer in the business increases. However, the pipeline includes projects for other customers which come online over a period of time. So let's say a couple of years ago, there was a customer, and again, I can't get into specific names, who was our largest customer. He's now our 3rd largest customer, and a customer who was our 2nd largest customer has become the largest customer in the last year or so. I think this will continue for another year, where again we hope that the clients, the top line of clients will change for us. as a company and as a sales team, we frankly are very, very aware and well seized of the fact that we need to reduce client dependence in terms of the concentration, and our sales team has the target to go out and get as much new business from new customers as they can. Does that answer your question? I mean, I can't give you granularity or percentages about the customer because, frankly, it then gets into our business model with the customer.
Understood. Not a problem.
The top 5 customers would probably account for around 70 to 80% of the business. The top 5.
Understood. And then secondly, a related question, Sameer. So just wanted to understand your thoughts on this, on the category mix as well. So do you think in your sort of a business, there is any benefit of increasing scale in the same category or the same product segment, say personal care or packaged food, etc., and cater to more and more clients, maybe look at export opportunities as well? Or you think there is not too much of a benefit and you can do equally good even if you are doing multiple products for the same client rather than expanding scale and getting some economies of scale on a same product line? So how does that work for you?
So frankly, that's a very interesting question, Himanshu, and as a management team, we've spent a lot of time trying to understand that. The way we are looking at it, I think for the next couple of years, we have enough runway to keep growing just the way we are, which means we are agnostic in terms of product categories, we are agnostic in terms of geographies, and we are agnostic in terms of the customer itself. I think post that, once we've achieved a reasonable size of, let's say, around 5,000-6,000 crores, I think that's when we will start looking at getting specialized within a domain and start offering contract research in addition to contract manufacturing. So you're absolutely right that we will eventually move into that model of offering domain expertise, contract research, and specialized plays within a product category. But I don't see that happening for the next couple of years because, frankly, the industry is so nascent right now that I don't think we need to get into that kind of a situation to be able to post further growth in terms of our numbers.
Understood. All right, that's it from me for today. Thanks and all the best to you guys.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Faisal Hawa from HG Hawa & Co. Please go ahead.
Congratulations on a good set of numbers once again. My question to you is, would we be looking at acquisitions of contract manufacturers who are already, supplying to these large corporates? Because you may get a lot of these assets at much less than book value, and with a market cap at almost 2 times sales, there is always that much more value you can create even by buying these assets at less than book value. So that's one. And secondly, how do you see this entire space of this food playing out? I mean, do you feel that will dominate our revenues going forward?
Dominating the rest.
Okay. Hi, Faisal. Thank you for joining in. I got your first question. The second question I'm going to ask you to repeat in just a second, but let me just talk about acquisitions. So if you've looked at us, we've actually been quite open to acquisitions all through our history. In fact, we've acquired a company, a division from Hindustan Unilever, one of our largest customers, and that's how we got into the shoe business. We acquired another shoe business from a company called G Shoes. Atc Beverages, which is located in Mysore, which has become our associate company, and our team is now planning to do the merger for that company. So acquisitions is something that we very, very actively look at. You're absolutely right that we look at acquisitions in a way which will add value to the equity shareholders and to the company. I do have a difference of opinion in terms of when you say that the fact that we are quoting at 2 times our sales, whether that gives rise to an arbitrage in terms of the equity value. But I take your point in terms of the fact that if we get an acquisition opportunity at book values or stressed values of our competition, we are definitely looking at such kind of opportunities. Now, your second question, I believe, was...
I'll just rephrase my second question. I think I did not even phrase it properly. My question is that, food is a much larger opportunity, and, large companies like Britannia, Parle are already having a very developed contract manufacturing ecosystem. And I believe in food, because of, regulatory concerns and overall, there could be a opportunity to make a little better margin. And already the contract manufacturing ecosystem of these companies is very segmented, in the sense it is like, single owner, or one owner owns two factories. A lot of consolidation, could happen there, and, a player like ours could really benefit there.
Absolutely. So two things. You're absolutely bang on in terms of being able to identify that, especially in case of segments like biscuits, etc. The contract manufacturing as a concept is definitely far more acceptable than in case of certain other food categories. So yes, there is definitely huge potential there. You're absolutely also right that there's a huge potential for consolidation in that category, because most of the competition that we have in terms of the contract manufacturing in those categories are promoters, entrepreneurs who've been able to set up one factory or two, but have not been able to scale up. And that's something that we bring to the table, and that's something that we can definitely leverage. So absolutely, I agree with you. Having said that, let me also just tell you that as a company, and at least for the next couple of years, we continue to be agnostic in terms of the category of the product itself, because the way our model is, the margins, especially in case of the dedicated manufacturing model, the margins are the same irrespective of the product category. So whether we manufacture pesticides or whether we manufacture foods, the amount of money that we stand to make from a factory would technically remain the same. So we are open to manufacturing anything further.
So this gross block of 250 crores which we are planning the next 1 or 2 years, this would result in a sales of potentially another 1,000 crores?
Okay, so I can't give you exact numbers. I can just tell you first, the 250 crores, the timeline is not 1 or 2 years.
250 or 450?
Just about a year. And in terms of our asset turns, I can just give you a thumb rule that we should be able to do between 3 and 4 times of assets.
So is it 250 or 450?
Once the factory has ramped up to its peak, we should be able to do an asset turn of 3 to 4 times.
So the gross block that you are planning is 250 crores or 450 crores?
250. 350 crores is our current gross block. 250 crores is the Capex that we have already announced. That's the Capex that we are talking about.
Okay, thank you so much. That answers all my questions.
Thank you, Faizan.
Thank you. We'll move on to the next question. That is on the line of Nikhil from Perpetual Investment Advisors. Please go ahead.
Yeah, hi Samir and team. Congrats on a great set of numbers. I have 2 questions. So, when do we see Atc Beverages stop bleeding on a quarterly basis and start contributing positively? I understand that last summer was not good because of the lockdown, but do we have any good plans here?
Nikhil, hi. You've touched a raw nerve, yeah. So, Nikhil, the logic of acquiring Atc Beverages was a couple of things, right? And one is it has a guaranteed and an assured supply of water from the government of Karnataka, which is an asset which we believe going ahead will be very, very important. You're absolutely right that we could have performed better in Atc than what we have. Last summer season was a complete washout because of the COVID. This season, and as you know, we are currently making only beverages there. This season is shaping up to be all right. But again, with the COVID situation, what is happening is that the consumer behavior as far as cold drinks is concerned is changing a bit. So, for example, people are still wary to have a cold drink because they think they'll get a sore throat, or they'll get a cough, or they'll get a cold. And that's really affecting the takeoff from Atc Beverages. As management, what we've done is, after having gotten beaten twice for 2 years already, what we've done is we've decided to hedge our bets in ATC. We've actually started building another factory in the same campus, which is going to be a shared facility for a different product category altogether. So we hope that Atc Beverages will start producing other product categories as well, at least by Q3 of the coming financial year, and that should then hedge it against the vagaries of the beverage business. Does that answer your question?
Yes. Just one follow-up. So what will be the quantum of Capex, and maybe you've already given us an idea about the asset terms on that. And what percentage of the land bank at the plant is currently used? I mean, your presentation says that the land bank is around 15.5 acres. Correct.
So Atc Beverages has around 15.5 acres. It has an assured water supply of around 250 KL. We are currently building a factory of around 35,000 square feet. But in terms of the availability of open space, I think we can expand at least 10 times more there.
Okay, got it. No problem. That answers everything that I need. Thank you and all the best.
Thank you so much.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Nishit Shah from Nepean Capital. Please go ahead.
Yeah, my questions were answered.
Thank you. Participants, in order to ask a question, you may please press star and 1. The next question is from the line of Vinod Malviya from Union Mutual Fund. Please go ahead.
Yeah, hi. Congratulations for a good set of numbers. Just one question from my end. I appreciate your outlook which you have given on the longer term strategies for the revenue growth. But can you just give some kind of numbers, like historically majority of your growth has come from acquisitions from the promoters as well as some of the inorganic growth which you have done. Going forward beyond FY22, what is it internally? What kind of a revenue growth you're internally working with? If you can share some thought on that, that would be very helpful.
So Vinod, thank you for joining in. One is that historically, when you say that we've grown through acquisitions and through promoter consolidation, that's partly true and partly not. A large part of the growth has come in through new Capex. I think we've invested close to 200 crores in the last couple of years, a little bit more than 200, and Mayank can give that number. Secondly, when we look at the end of this financial year, or rather by August, when we expect to have merged our malt beverage unit in Coimbatore and Atc Beverages, subject to the NCLT permissions, nearly 90% of the promoter business would have already been consolidated. So going ahead, I don't think the growth is going to come in from consolidation from the promoter business. However, we are very, very confident about the growth in spite of the fact that it's not going to come in from projects or factories that we already have. And that's because of a lot of visibility that we are working on, a lot of projects that we are working on. What we will do is, I think in the next 6 months or maybe next 4 months, we will have better details on this. We will definitely try and give more granularity in terms of our expansion plans for the financial year 23 onwards, maybe in our next investor call or maybe in the annual report. But for FY22, you know that we've already given out our guidance, and we are quite confident that we should be able to meet that. And for FY23, it's looking good as well.
Okay. The reason I was emphasizing more on FY23 is because generally, if you have to grow, organically, when I say organically, going for a brownfield expansion or a greenfield expansion, it will take at least 6 to 9 months for the new plant or new capacity to come on stream. So for a new revenue which has to come from FY23, you should at least start now doing, your drawing has to be started now. so that the plant by end of FY22 comes on stream and starts contributing to the revenue. As of now, what I know is that there's a one facility which is coming in Hyderabad, which will come from Q2, and there is another facility in the North India, UP facility, which has already been taken into consideration for your majority of the FY22 revenue, except for the UP facility. So I really don't have much visibility in terms of FY23, what kind of a revenue, as a company you would be able to deliver. So I was just emphasizing more on FY23 numbers. So what would be the likely growth rate?
Okay, happy to give you some generality on that, Vinod. So if you look at our last quarter turnover, it was around 380 crores, and the quarter before that was I think around 320 crores as well. So if you look at our run rate, even at a 350 level, we are already at a run rate of around 1,400 crores as far as annual figures is concerned. So when we are talking of the 2,000 crore turnover next year, it actually does not take into consideration full running of the Capex that we have already announced. Right, so the current new Capex that we have announced, which is the 250 crore Capex, will add to revenues beyond FY22 as well, because what it will do is it will come in FY22 and it will ramp up beyond a certain time and contribute completely in FY23. So part of the growth will come in from the existing Capex that we have announced. Part of the growth will come in also due to new projects, new pipeline discussions that we are having, which, as I said, we're not at a liberty to discuss right now. Maybe in the next 3 or 4 months, we'll give you more details about FY23.
Okay. And can you just provide some timeline, like when are these two entities which are trying to merge? Any timeline, like when do you expect that the thing to get merged?
I'm going to ask Mayank to answer that question. Just hang on.
I so we are stuck in NCLT because we have filed our application with NCLT in October, but still the order is not be received. Okay. So there is definitely a procedural delay at the NCLT, but we will try to do it by August actually. July August complete.
Okay. So it's only a regulatory delay, nothing delay from our side or from the other.
So we have filed this application in NCLT in October. The order is still not received, then we have to do the EGM and all this thing. This is the process delay only. There is nothing else holding it up.
Okay. As you can imagine, Vinod, because of the COVID, the courts are also not functioning completely at their full strength, and unfortunately, we've been a casualty of that.
Yeah, thank you. I appreciate your answers. Thank you. That's all from my side.
Sure. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Ankit Agarwal from ARC Capital. Please go ahead.
Opportunity. So you have been growing exponentially for the past few quarters. So can we expect this growth part to continue for the next few years?
Ankit, you are sounding like my board of directors now, yaar. They are also asking me the same question, and my answer is inshallah yes.
So I mean, how are we going to maintain this growth, sir? I mean, you have any plans for that?
So Ankit, like I mentioned in answer to the previous question, and like we've tried to elaborate in the investor presentation and all the press releases, we are going in for a substantial Capex. We've like I said, we are investing close to 250 crores in the next few months, 1 year. In addition to that, our sales team is out there working, trying to get new projects, trying to set up new customers, etc. And I think all I can say is I'm reasonably confident about growth. We'll see how much and we are able to deliver. But let's say that all of us here are working towards it.
Okay, so with this investment in the Capex, how do we see the balance sheet evolve over the years?
So
Mayank is answering this.
So Ankit, this is Mayank here. So,
Yeah.
so we have a current, as we told that current debt equity ratio of 0.91.
Yeah.
As because the new facility entail a new debt, as we indicated that we will have the 75-25 ratio of debt versus equity for the new project. So right now we have say 220 crores of equity and 200 crores of debt. That will change.
Right. Okay, so that's good. And some questions regarding the order book. So what is the current order book for the company under the different segments?
Okay, we've kind of indicated that we should be able to do 2,000 crores by FY22 for an annual figure. So basically, that's the number we are shooting for.
Okay, and so you have new Capex coming online, and so sir, from the existing capacity, what is the optimal capacity utilization that we can expect from the existing facility?
Ankit, so for us, in case of dedicated manufacturing, capacity utilization is actually it's a wrong indicator because for us, in terms of dedicated manufacturing, it's a take-or-pay contract. So as a result, we do not have any operating leverage. We have once the capacity is ramped up, we manufacture at that capacity for the next 5, 7, 10 years, whatever the contract is. The ramping up generally takes between 3 to 6 months. And like Vinod was saying earlier, a new unit, the gestation period from the time we do groundbreaking to actual production is between 9 months to a year. So within that timeline is what we ramp up from groundbreaking to full capacity utilization. Post that, it's constant for the next 5, 7, 10 years, whatever the contract is.
Okay, understood, sir. Fine, that answers my question. Thanks and best of luck for the future.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Sagarika Mukherjee from Elara Capital. Please go ahead.
Sir, thanks for giving me the opportunity. Sir, in your current revenue mix, or let's say your revenue mix in the forthcoming future in the next 3 years, will it be more HPC or will it be more foods? That's my first question.
Sorry, is that your question? Yeah?
So in your current revenue mix, which is today, let's say your HPC versus foods, if you could give your current revenue mix today, and how does it look in the next couple of years, let's say after you're ramping up of the UP plant, etc. for foods?
Yeah. So Sagarika, we actually don't maintain segment-wise accounts. And as I've been at pains to explain even earlier, I think to an answer to Himanshu's question, we are quite agnostic as far as product categories are concerned. So we are indifferent between home care, personal care, as well as foods, especially because in case of dedicated facilities, our business model is the same irrespective of the product category. In terms of our wish list or our domain, like I said, we concentrate more on hedging the debt against the customer. So we want more customers. We want to diversify against, we want to diversify our customer base. We want to diversify our product categories and geographies. But like I said, we don't look at it as HPC or foods. We are happy to manufacture food. We are happy to manufacture pesticides. We are happy to manufacture toilet cleaners.
Right. So just in general, wanted to understand then, let's say your margins or your profitability in a dedicated manufacturing versus a non-dedicated manufacturing, in which case will it be higher, and what is the mix today in terms of your capacity in the two things, like one dedicated and the other one which is not dedicated?
Okay. So the dedicated manufacturing is accounting for close to 80-85% of our business. The margin profile, when you look at it as a percentage of sales, is better in case of shared facilities and private labeling, and lower as compared to dedicated manufacturing. That's in consonance with the fact that in case of dedicated manufacturing, we do not take on any risks, either in terms of operating leverage or in terms of working capital and inventory obsolescence. However, in case of shared facilities, we take on the risk of operating leverage, and in case of private labeling, we also take on some risk of inventory obsolescence.
So the forthcoming 250 crores of capex, you would say is dedicated or non-dedicated in nature?
90% of it is dedicated. The small part of it, which is coming up in Mysuru, is our shared facility.
All right. And so over the years, I mean, you've had a very great transition in terms of adding product categories, clients. I mean, it's like amazing set of clients that you have across categories in India, genuinely. But would you say that over the years you've added more work from the same client, or has it been like a new client getting added for new categories or skill sets that you've acquired over the years?
Rika, we would like to say both. So we continue to work with new customers, but we also continue to increase wallet share within our existing customer base. So frankly, I would not be in a position to tell you which has worked better for us. We've done both of it.
Right. And so this whole guidance that you're giving that today your margins are squeezed because there's, the inflation has been just abnormally high for the whole industry, and hence passing on and etc. All of these things have been slightly tough for everybody actually. But then the outlook that you have that your margins will stabilize again, it comes from what kind of comfort that you're getting from your clients? As in, how should your margins increase? Is it just the reversal of the commodity prices that you're expecting, or is it something else?
Satvika, our business model is such that our margins are protected by virtue of a contract. So as a result, the raw material prices, frankly, even if they start becoming benign or even if they go down, the benefit goes back to the customers. Our margins are protected upwards as well as downwards.
So then why should your margin decline this time then?
That like Mayank was explaining, there is a time lag. And what I was explaining to Anand in his first question was that we are very confident that this margin erosion will get recovered within the next couple of quarters, in absolute sum as well as in terms of percentage.
All right, sir. Okay, thanks a lot, and all the best.
If I'm not here, maybe we can connect offline, and you can send an email to Bankim, and I'll try and answer it better.
No, so I was just trying to understand, let's say today your margins are 9%, gross margins 9% or 9.5%. Then do you expect it to go up something like crossing 14 so that you can say over a period of time your margins remain stable? But if it just goes back to 12, you're just back to normal. You've not really recovered the losses that you had in this short period of time.
So again, what do you want me to answer? I mean, in terms of our margins, whatever our historical performance is, that should be the way the margins should be. As far as this particular quarter is concerned, it was a little bit of an abnormality, which is why we as a management team decided to flag it off. Going ahead, we expect it to normalize again to the levels that it was in the past.
All right. Thanks a lot, and all the very best for everything.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Vinod Jairam from Composite Investments. Please go ahead.
Yeah, hi, thank you. So you have been experiencing tremendous growth during the last few quarters. What I wanted to understand was, is it just you that is growing, or is it a general trend of increased outsourcing of manufacturing within the FMCG industry? And if it is the latter, could you talk about the reasons supporting the growth in that segment?
So, Vinod, first of all, thank you for joining in. And we've been fortunate on both counts, right? A part of the growth, I would like to say, is because of our efforts, and obviously we would like to claim some credit for it. But yes, you're absolutely right that we are also fortunate to be in an industry at a time where it's growing disproportionately. We've taken pains to try and explain this in our investor presentation and in our annual reports, etc. Where what we're saying is that because of certain macro changes, the bigger ones being GST, the bigger ones being change in the distribution networks of the FMCG companies, we are seeing some huge tailwinds, which is helping the contract manufacturing space. I'm happy to take you through that thesis, but like I said, a lot of it has been explained in our investor presentation, and I just broadly touch upon it without getting into too much detail so that I don't waste everyone's time. But broadly what's happening is decentralization of manufacturing in FMCG is becoming a thing because of GST, because of the fact that the distribution network is becoming more and more modern trade and e-commerce. And as a result, all of this is leading to a demand for new factories. The COVID in the last 6 months has further accelerated this process because people realized in those 6 months that supply chains were very, very delicate. I'm sure you are aware that when the lockdowns were announced, there were stores which were running out of even basic staples, etc. And FMCG companies have realized that they need to have a far more decentralized supply chain. It does not make sense to manufacture a product in Himachal or in Baddi and then ship it all the way to Pondicherry. And now they would much rather have a factory closer to the market. So contract manufacturing is gaining because of this decentralization. You're seeing this, frankly, not only in our industry, you're also seeing contract manufacturing increase in terms of its importance, even in other categories like electronics, etc. So frankly, we've been blessed to be in an industry which is growing. And within the FMCG industry, I think we can humbly say that we are the largest contract manufacturers in the industry, and we are pretty much the go-to for all FMCG brands who are looking at contract manufacturing.
Great. Thanks for that detailed answer. And you had also mentioned in one of the previous con calls about going forward at a later stage, you would also look at putting in the R&D efforts in terms of developing the products. So where do we stand on that? Is it still early to talk about it, or are you already planning on that front?
So we do some very, very basic level of R&D. Since we've last spoken, we've launched, I think, around 20 private label products for various customers, various small brands, various D2C brands. However, I would hate to say that we're doing cutting edge R&D. I think that's at least 2 to 3 years away, Vinod.
Okay. And lastly, would you be able to talk about the revenue concentration in terms of how much does the top client contribute, or probably a top 5 or 10 clients? And also, how many clients do we have, and how many have we been able to add in the last 1-2 years now?
So we actually work with most of the FMCG companies in the country. Like I answered when Himanshu asked the similar question, was that we are unable to give out client-wise business percentages, but just at a very top level, around the top 5 customers will constitute around 70 to 80% of our business.
Okay, and approximately how many clients would we be dealing with?
Vinod, so when you come to private labels, right, so we work with so many D2C brands that if I count each of them as a separate client, this would be like more than 50 years.
Got it. Sure. Thanks for your answer.
Sure, thank you.
Thank you. We'll move on to the next question. That is on the line of Nikhil from Perpetual Investment Advisors. Please go ahead.
Just a small follow-up. So I think that looking at your business from a margin point of view doesn't make sense. So rather, I can ask you that the current ROC of the business is around 18 to 20%. But when can we start seeing the incremental ROC to be higher than the current one? I mean, I can just think of 3 reasons where this starts moving up. One is, like you already spoke about, that currently you are a CMO or a CDMO and you start shifting towards more on the cram side of the business. The other is higher share from shared facilities. And do you have any plans for backward integration, maybe into oleochemicals or something like that?
Okay, Nikhil, bang on. So to answer your question, I mean, you've frankly already laid out the answer to your question. So let me just talk about the second part of your question about what we intend to do about the ROCE. So you're absolutely right. Shared facilities is something which will give a huge sweetener as far as the ROCE is concerned. We definitely believe that shared facilities will be our go to for the future. However, I think for the next couple of years, what we intend to concentrate on is building more dedicated facilities, having more assets on the ground. If we have to invest the kind of money that we are investing, we obviously cannot and do not want to allocate capital for shared facilities because they come with an inherent risk which the dedicated model does not. So when we are talking of investing 200-250 crores in a site, we obviously would like to do that on the back of a very, very tight contract. So for the immediate future, you're absolutely right. Private labeling, which is the CDMO part, the shared facilities will be the way to increase our ROCs. The other things that we do to try and increase our ROCs are basically Mayank's area where the treasury and Ganesh's area where the operations try to add some benefit in terms of our operating leverages and efficiencies.
Got it. And anything? Do you have any plans for backward integration?
Oh yeah, I forgot about that. Nikhil, not right now. I think we've got our plates full and we see enough pipeline to keep ourselves busy for the next couple of years at least, and to be able to post the kind of growth that we are. If we find that growth beginning to taper off, or we find that we have more time and money to do stuff, we'll look at that. But currently, no.
Okay, sure. Any indicative range of where the ROC can be, maybe 5 years from now?
Nikhil, we can't get that. Yeah, I mean, I have no idea myself.
Okay, no problem. Thank you.
Yeah.
Thank you. The next question is from the line of Amit from World Food LLP. Please go ahead.
Hi, my question was, why aren't these companies setting up their own plants with India's young population and so much consumption and driving? Why are they shying away from setting their own factories?
Amit, I think that's a perfect question to end the investor call on. That goes right to the genesis of why are we here. So if you followed our company, or if you were there in the investor call last time, or if you've read any of our annual reports, the classic question is why do people contract manufacture, right? And the question is the same that you would ask Apple about why do they not manufacture their phones, or why would you go and ask another company why would they outsource everything to Foxconn or to Bridgestone, etc. I think in terms of contract manufacturing, what people have realized is that everybody would like to specialize in what they do. So Apple would like to specialize in terms of innovation, branding, marketing, etc., while Foxconn can specialize in terms of manufacturing. The same thing is happening in FMCG, and I'll just elaborate on this in two ways. One is the established brands, the bigger brands. They are realizing that the marketing landscape and the competitive landscape is changing because of the entry of new brands, because of the entry of new distribution networks. So they want to concentrate on the marketing and the branding and the distribution. They've realized that manufacturing is not the value add as they think it is, and they are happy to outsource it. Then you come to the second players, or the second chunk of brands, which are the D2C brands. The D2C brands or the startups are frankly not interested in manufacturing anyway, because they have realized that capital is scarce, and they would much rather invest that capital in building brand and marketing and distribution capabilities. So both of these players, right at the top end of the established players as well as the bottom end of the new players, are beginning to look at contract manufacturing more and more than looking at setting up their own manufacturing. There was a time when they were doing more in-house manufacturing, and that was more because of certain tax breaks that companies got. I have got into detail in this in both the investor presentation as well as the annual report. Happy to get into those details separately because that's the entire thesis about our company, right? We exist because we strongly believe that contract manufacturing will be the way going ahead.
And would we see Hindustan Foods build its own brand in a few years, or we will only remain a contract manufacturer?
Not till the current management is in place. I don't think we will get into the branding, but never say never. They might fire me and bring in a new managing director who's more into branding and marketing.
Okay. All right. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was our last question. I now hand the conference over to Mr. Vimal Solanki, Head Emerging Business and Corporate Communications, Hindustan Foods Limited, for his closing comments.
Thank you so much. So the demand for contract manufacturing in the FMCG industry has been and continues to grow, and we at HFL are in continuous discussions for new projects with our existing as well as new customers. Very recently, we announced a Capex of 125 crores in the North India. This is on the back of the 150 crores that we've already announced earlier. We keep looking forward to more such projects in the near future. As of date, as we have been told, we are confident of achieving our goal of revenue of rupees 2,000 crores in FY22. I take this opportunity to thank everyone for joining on this call. I hope we have been able to address all your queries. In case you need any more information, please get in touch with us or our investor relations advisors, that is Strategic Growth Advisors or SGA. Thank you all, and wishing everyone a successful last quarter of this year. Stay healthy, stay safe. Thank you.
Thank you. Ladies and gentlemen, on behalf of Hindustan Foods Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.